given enough opportunity, any weird thing will happen just due to chance. So even if you're not suspecting it, you will notice things that are just due to chance. But the important thing about money management, about playing games where there's risk, even if you have positive expected value, you need to know about proper managing your money, and you need to have proper respect for the laws of chance.
Hello, ladies and gentlemen, and welcome to our interview with Dr. Michael Orkin. Michael is a renowned statistician, a data scientist, and author of the new released book, The Story of Chance, What's Luck Got to Do With It, by Kendall Hunt. And Dr. Orkin is a Professor Emeritus of Statistics at California State University, East Bay, and he currently serves on the mathematics faculty at Berkeley City College. And throughout his career, Dr. Orkin has made significant contributions to the field of statistics, particularly in the gaming industry. So, Michael, welcome to our Risk Management Show podcast today.
Well, I'm glad to be here, and thank you, Boris.
Absolutely, it's my pleasure. So I believe that we will have very thoughtful conversation on the topic of perplexing role that luck plays in our decision-making process, and I will discuss also how understanding the mathematics behind chance can empower you to make better and more informed decisions probably for our risk managers in both their personal and professional lives. But before that, Michael, could you tell us a short story about yourself, your career path, and what brought you to where you're right now and what you're up to these days?
Yes, well, I grew up on the East Coast in America, in the Washington, D.C. area, and then I decided to go to University of California at Berkeley, partially because it had a very good math department. I wasn't aware of their statistics department at the time, so I went to UC Berkeley and became a math major. And when I was a senior, I took a course in probability, and the professor convinced me to go to graduate school in the statistics department. And that's when I got interested in things like game theory and data science, big data. That's where I got my PhD. And from there, I went into academia. I began as a professor at California State University, as you said previously. But in the course of this, I started doing some consulting. And as the years went by, I wrote a couple of books. I've written a number of academic papers over the years, but I got very involved in, more recently, I got very involved in consulting with the gaming industry in a certain area. Namely, there are many new developers who want to get on the iPhone or the Android with their games, and what they want to do is have wagering. And it's not so easy to do that. There are plenty of games on your mobile phones, but they don't all involve, in fact, very few of them involve wagering. But because of the Internet Gaming Act, which was relaxed a few years ago, you have to show that the games are not games of chance, in which luck is the only way you can win, but games of skill, where a skilled player, like a chess game, for example, the most active type of wagering on online gaming right now is sports betting. But in any event, the developers needed someone to write a report showing that the game is a game of skill, not a game of chance. And so that's where I came in, having done a lot of work in that area. So I do a lot of consulting in that area right now. There are just lots of activity and lots of companies who want to change their games a little and allow wagering.
All right, fantastic, very interesting.
That brings us to the present, yeah.
Yeah, very interesting topic. I know that there are a lot of games now, and all young people are always on their apps and computers doing these games. So let's discuss, because our audience more kind of mostly risk managers, compliance professionals. Maybe we can do something specific to them, and you can start. We can start by explaining the fundamental principles of chance and how they apply to our daily lives. Of course, our risk managers also probably they studied all this probability theory, but maybe if for you just a reminder, what does it mean for us to apply this theory?
Okay, so I'll give a little overview of these topics that you mentioned. First of all, let's just talk about a game of pure chance, namely the lottery. So lotteries have been around for thousands of years. The word lot is in the word lottery, and that means a parcel of land. And lotteries were originally developed to hand out parcels of land to people. And then over the years, they became popular in Europe, and they involved just trying to predict what randomly drawn numbers would be. No parcels of land, but you get a prize if you won. And countries would use lotteries to raise money for whatever they were doing, having wars, building up the infrastructure. So now they're in the United States, and of course the same is true in Europe. In the United States, there are two big lotteries that are called Powerball and the Mega Millions lottery. And they're multi-state lotteries, so you can play them in most states in the US. And the Mega Millions lottery is a good example of chance, of something that's just pure chance, and the only way you can win is if you get lucky. Luck, of course, means good luck means doing well without any skill, just because of chance. So the Mega Millions lottery is a good example of how luck works. So the chance of winning the Mega Millions multi-state lottery in the US is about 1 in 303 million. And to put that in perspective, if you buy 50 lottery tickets a week, you'll win the jackpot on the average of once every 116,000 years. That's what 1 in 303 million means. Also, another analogy, this makes people realize what that kind of number that is. If you have to drive a mile to buy a lottery ticket, then by the time you win the jackpot, on average, you'll have driven about 633 round trips to the moon. And another example, if you know, let's say, so here in the US, let's say you know one person in Canada, and let's say you put the names of everyone in Canada in a hat, and close your eyes and draw a name, and at the same time you buy a Mega Millions lottery ticket. Well, you're 9 times more likely to pick your friend's name out of the entire population of Canada than you are to win the lottery jackpot. So, in speaking about the Mega Millions lottery, it's so unlikely to win, as is illustrated by the examples I gave. Then the question is, why are there winners? And there are winners fairly often. In fact, not every time there's a drawing, but there are winners. And the answer is due to this very important fact about luck and chance that is sometimes called the law of truly large numbers. And it's stated as, given enough opportunity, any weird thing will happen just due to chance. Now, in this case, the weird thing is that someone will actually win the Mega Millions jackpot. But the reason that somebody wins is because there are so many tickets sold. And another way to put that is that when you have a situation of pure chance like this, that involves the possibility of a lucky winner, given that there are lucky winners, for every lucky winner, there are millions of unlucky losers in the case of the Mega Millions lottery. And so I like to say that luck is a group activity, namely the group of people who buy tickets. And so out of that, the opportunity arises to have a winner. And so when you think about an unlucky event happening, it's not really the right way to look at it. If you think about what's the chance that I win, or what's the chance that some particular person wins, The right way to look about it, to think about it, is what's the chance that somebody wins? And when you look at it that way, then you see this fact that the more people in this case who buy tickets, the greater the chance is. Your chance is always the same, 1 in 303 million for the Mega Millions lottery. But when there are lots of people, then the chance that someone wins gets larger and larger. And that's why you see lottery winners.
No.
Now,
And
go ahead.
no, just go ahead.
Okay, so now, the Mega Millions lottery and many casino games are like the games of craps or roulette, are games of pure chance. The only way you can win is by being lucky. There's no skill. But there are other games that involve skill. And so some of them are obvious. Like if you go, and this is not a game you play in a casino, but if you go out and actually do something like go bowling or go out or if you play chess or checkers or the Chinese game of Go, those are all games of skill. It's clear. But now what about if you bet on a sport, on the outcome of a sporting event? Is that a game of chance or is it a game of skill? Or what about if you play a game of blackjack in a casino? That's the game of 21, very popular casino game. Is that a game of chance or is it a game of skill? And so one of the questions that I encounter frequently in my consulting, and also when I talk to my students about, is how do you tell the difference between chance and skill? And this sounds maybe a little bit focused just on certain types of games, but it actually has much broader possibilities or much broader implications. So let's just look at how do you decide if betting on sports? Let's say you bet. So you're in Europe, you bet on soccer games. How do you know if that's a game of chance or a game of skill? Not playing the games themselves, but betting on them. So one answer is you study, like if you study the game of blackjack, you'll see that there are some strategies that were developed, but generally speaking, you have to look at data. You have to look at player data. So this is sort of like a risk thing. You have to examine data and see if there's some people who do better than luck. Now, how do you decide if someone's doing better than luck? Well, the way to do it, it's a standard statistical thing. You've probably heard the term statistical significance before. It's a standard way of testing the results of data from a sample or from a clinical trial or whatever, in which you have a significant result, which means it's very unlikely that this result happened just due to chance. So the field of statistical inference is built around this idea, namely testing a hypothesis, as it's called. And one of the hypotheses that you're testing is called the chance hypothesis or the null hypothesis. So when you say there's a significant result, whether it's in the insurance business or the medical business or the gambling business, it all has the same meaning. It's that your result or the researcher's result is happened for some reason other than luck. So that's what I do in a typical analysis of a game to see if it's a game of skill, which is important nowadays because game developers cannot have gambling games on their iPhone or their Android unless they can show that the game is a game of skill.
But what about for example, some financial products they sell, for example, options and binary options that you can bet on the price of everything goes down or up within a few seconds or few minutes or few hours.
Oh, right. So like if you're a day trader and you're trying to make get in people who like the action of day trading. And so it's really the same thing. And if you look at one way, not the only way, but one way to see if these people who claim to be experts in whatever field, whether it's betting on a sporting event or buying and selling options, is to look at their wins and losses or their average profits or something like that, and to see if their results are significantly better than some baseline or some chance result. So it's all the same thing, and in the sense of statistical testing. Now here's another interesting thing. One huge area, which also involves chance, is when insurance companies have to decide if someone is accident prone. Well, you may have run into that. Most people have, because their car insurance went up if they got into a minor accident, no questions asked. In California, it's called a no-fault type of insurance, where one person isn't necessarily at fault. Same as divorces in California, which is another game of chance versus skill, I guess. But so how do you tell if someone's accident prone? Now, this is important. Now, there's thousands of research papers have been written on this over the last 50, 75 years. And now there are these terms floating around, like having a predisposition for accidents. So if you work at a company and you have more accidents than most people do, you might get labeled with that. You have a predisposition for accidents. So what does predisposition mean? Well, it means sort of what it sounds like, namely, somehow magically you get into more accidents than other people. And it's maybe genetic or maybe whatever. Now, of course, there are other things that can be eliminated, like if you are taking drugs or drinking, then obviously that's not good, and you're more likely to get in accidents. But weed those people out and look at the situation of if you're an insurance person, how do you decide if a particular person is accident prone? Well, I had a consulting job about this a few years ago, and a person was fired from her company. It was a very large company, thousands of employees across the US, because she was called accident prone. So I was hired by her attorney to look at the statistical results. And she did have a few accidents, none of them serious, but we asked for an explanation from the company statistician, as to how they decided that she was accident prone compared to other people who might also have accidents. And the company's statistician said, well, she had more accidents than average. So that is definitely not the right answer for deciding if someone's accident prone, because just the mathematical definition of average, there are always going to be some people who have more than average and less than average. It's just part of the nature of average. And so if you're the unlucky one who has more accidents than average, you shouldn't be fired because of it. There has to be more. And the more is, whether it's predisposition, I have no argument with the terms the insurance industry uses, but somehow you have to show that there's a significant, the number of accidents is significantly higher. And it's the same as looking at the reverse, but it's the same math as looking at a gambling game and deciding if someone is winning because of skill or because they were just lucky. It's in the reverse of that, is someone having more accidents than average because they're accident prone, or because they're just unlucky. And the way to do it is the same way. You see if they have a significant number of accidents. So in this particular consulting job, we asked the statistician for the company how they decided that this person was having more accidents than average. And they said, well, they just took all the data from the accident data from the entire company, thousands and thousands of people, and she was higher than average. So it turned out that this company has about half their employees had desk jobs, and about half their employees have jobs out in the field, which are much riskier. So this is about risk management. And the statistician for this company lumped everybody together when he computed the average. My client had a job out in the field. And so we went to the bottom line is we went to a mediator. The mediator, we thought this would take a couple of weeks to get an answer. The mediator heard both sides of the story, walked out of the room and came back in 20 minutes and said that the company's arguments make no sense. So they rehired the person and promoted her, and she's still working for this company. But my point is, when you're trying to decide if someone's accident prone, fine, some people may have predispositions. I'm not arguing with that, but you have to do more than say they had more than an average number of accidents, because that doesn't really mean anything.
That's fantastic. Yeah, and a good case study. So how can just normal people, or maybe gamblers and sport funds, or even risk management and investors benefit from a deeper understanding of probability, as you just described in the case of this person that was fired and rehired?
Okay, so first of all, they can understand how chance sort of permeates everything because of opportunity. There are so many people doing so many things, like buying lottery tickets, that many things will happen just due to chance, and that there are some situations that are pure chance where there's no skill possible. And mainly, you can find these situations everywhere, but in the games, in the casino games of craps or roulette or keno or lotteries, those are great examples. Now, let me give you a little story about risk management. So the game of blackjack, or 21, was found to have strategies that you can win in the long run. And these were developed by doing computer simulations by IBM programmers back in the late 1950s. So the mathematician Ed Thorpe wrote a book called Beat the Dealer, in which he presented some blackjack strategies. So in these strategies, sort of on the average, sort of just roughly, you had a 51% chance of winning and a 49% chance of losing, sort of overall. There are good situations and bad situations. But suppose you were an expert at one of these strategies, and I'll show how this applies to a more general situation in a minute. Then you have a winning game. That means you can guarantee winning in the long run, but that's not the end of the story, because you have to. So, for example, suppose you have $10,000. You bet the entire $10,000 on each hand, and if you win, you bet whatever you won along with the $10,000. Well, you're going to lose about 49% of the time. So within a couple hands, you'll go broke, and you won't be able to take advantage of this good situation. And so the thing that has to go along with a good situation, like if you're an options trader or a blackjack player or taking out some other kind of risks that involve winning or losing money, you have to have a money management strategy. You can't just bet everything. And so back in the 1950s, a mathematician at Bell Labs named J.L. Kelly developed something called the Kelly system, which is called a fixed fraction betting system. And what that means is the more you have, the more you bet. The less you have, the less you bet. You're always betting the same fraction of your bankroll. So if you're betting 10% of your bankroll, you have $1,000, you'll bet 100. If you have $500, you'll bet 50. And so it's hard to go broke doing that, because if you happen to be unlucky, because even in a game of skill, there's luck involved, even in a game of blackjack, even in options trading. Luck is still part of it. Chance is still part of it. So if you have an unlucky losing streak, you won't make a fatal mistake of betting all your money, and then you'll be out of the game. So let me give you an example of someone. There's a chapter in my book, Story of Chance, about this person, a very well-known person who was known as the Crypto King, who was the world's greatest crypto trader, Sam Bankman-Fried, otherwise known as
Oh, yeah,
SBF.
of course, the fraud guy.
Yeah. So, yeah, they called him the fraud guy, and that's how everybody thinks of him now, as the fraud guy. But he was a smart guy. He went to MIT, he had a degree in math and physics, and he learned about positive expected value, which is what a game has to have to be profitable for you in the long run. Like blackjack has a slightly positive expected value, sometimes called plus EV. Now, a game like craps or roulette or a lottery has a negative EV, which means you do it over and over by the law of averages, you're guaranteed to lose. But the law of averages doesn't work quite like that for plus EV because you have to have proper money management strategies. So Sam Bankman-Fried was very good at understanding what positive expected value is. And he would find, there was a book about that by, last name is Foe, it's called One Number, Number Go Up is the name of the book. He had many interviews with Sam Bankman-Fried before his downfall. And Sam Bankman-Fried was always analyzing opportunities in the crypto world to see if they're positive EV, positive expected value, which means you can win in the long run. Unfortunately, he didn't have the same knowledge about money management. And so he would take risks regularly making these crypto bets. He had two companies, a crypto website where people can invest and his own hedge fund called Alameda Hedge Fund. And he started making bets that were much bigger, even though there was positive EV, even though he did have positive gains, at least for the most part. He did everything sort of on the back of a napkin. He didn't make serious mathematical computations all the time. But he started making bets bigger than he could make, and he started losing because of that. He couldn't cover his bets, so he started borrowing from the investors who didn't know what was didn't know that that was happening. And once you get onto that situation, it's a slippery slope, and you eventually get into serious trouble. It's illegal, for one thing, to start taking money from people who don't know that you're taking money from them. And so he wound up in prison. But one of the main reasons was that he didn't know how to manage his money. He had plenty of opportunities to make money in the crypto world, but if he bet too much, he winds up in prison. So that's another example of how money management is an important, a key part of taking risks in the financial world.
All right, fantastic. So there are a lot of interesting case studies. Where can our listeners find your book and learn more about your work?
Okay, so my book is called The Story of Chance. What's Luck Got to Do with It? I don't know if people can see that, but anyway, The Story of Chance, What's Luck Got to Do with It? And it's available, and I have a chapter on Sam Bankman-Fried. I have a chapter on a bunch of things, of the things that we've been talking about today. And it's available in the online booksellers like Barnes & Noble or Amazon. And so that's the best way to get a copy. I'm also on LinkedIn. So if you go to LinkedIn and enter my name, Michael Orkin, you'll be able to find me there and get some more information.
All right. So let's just summarize our interview for someone who is listening and would like to walk away with one or two major takeaways. What would it be? Okay,
so first major takeaway is that luck or chance is everywhere. And even if you have a game of skill that you're playing, there's still probably some element of chance involved. And even if you have the two greatest chess players, someone will forget something or not make the right move. So you could even say that luck sort of is in there a little bit, but certainly if you're in the financial markets, and even if you have great skill, there will be times when you'll have a losing streak. That's just the nature of things. And so you need to have proper money management when you are doing things, because otherwise the fact that there's luck and chance around, you're never going to win every single bet. And so, as I said, that given enough opportunity, any weird thing will happen just due to chance. So even if you're not suspecting it, you will notice things that are just due to chance. But the important thing about money management, about playing games where there's risk, even if you have positive expected value, you need to know about proper managing your money, and you need to have proper respect for the laws of chance.
All right, fantastic, Michael. So that's why all my questions. We know where to find your book. So I wish you a great success and in your career, both in the consultants, in the academic world, and also in your writing endeavor. So thanks again, and we will be in touch with regard to the interview and maybe follow-up interviews on specific.
Okay, I'd be happy to do a follow-up, and thanks, Boris, for having me on your show.
All right, thank you.